Welcome back. It is Wednesday, and as always, Andy and I are here with another investment opportunity for you all. We are doing another live underwriting this week of a triple net car lot. Andy, what you got for us?
Yeah, guys, welcome back to another underwriting video. We have a pretty exciting project to share with you guys today. As Tyler said, it's a car dealership here in Tennessee, and what I wanted to walk you guys through, especially today, is how we look at credit underwriting from a very top-down level. So this is a very, very basic analysis of how we would look at credit underwriting because this specific deal actually deals with a essentially startup, a very, very new company to the space, to the car dealership space. And one of the most important things about a new company is that, you don't know if they're going to succeed or fail. And that obviously has a huge impact on your real estate valuations when you're depending on this company, because this company has a corporate guarantee on its lease. When you're depending on this company to have the rents, to have your real estate be valued where it is. So wanted to walk you guys briefly of how we go about underwriting that credit risk for those tenants and comparing it to other corporations in the space. So Tyler, if you want to share my screen here, one of the big competitors obviously in the space is Carvana, right? Everybody knows Carvana. Carvana's the one with the big vending machine that shoots cars out. You can press a button, it'll come down. So Carvana obviously brands itself as a tech forward company and all that kind of stuff. And what may be interesting to you guys is, and this is, by the way, Yahoo Finance. And this is a very easy way to get a very quick analysis of a company's financials, because that's what you're doing when you're trying to check credit risk of a tenant and they're a publicly traded company. You can check their financials. And when they're a private company or just a individual, you're going to be asking for their personal financial statement, and you're going to be looking at previous operations for their companies, right? Those are all things that you're going to want to look at. For this sort of deal where it's a publicly traded company with a corporate guarantee, you can look at their financials and they're all public information. So Yahoo Finance is a very easy way to look at that. So you see here for Carvana, and obviously here's the stock price and all that kind of stuff. A couple of things to point out, the easy things to point out is the market cap, and which kind of generally tells you how big the company is, right? And Carvana is a 40 billion, $39 billion company here. It's a pretty big company. What may be surprising to you all is that Carvana actually is not really that profitable. So they have what this says here, 6733565, and this is on their financials page of the income statement. They have 673,565. All these numbers are in thousands. So this 6 million, 6.7 million actually represents $6 billion of revenue, $6.7 billion of revenue. What's interesting about Carvana, but a lot of you guys didn't know, they're actually not profitable. They actually lose $253 million a year. So they're a $40 billion company and they lose $250 million a year. One of the perks of being a tech company is that you can be an unprofitable company and still be worth a lot of money.
Yeah, you don't have to make anything.
So, and not to say that Carvana is really a tech company. You just got to brand yourself that way, right? I mean, they sell cars and they just allow you to send cars to your door, right? But all that aside, the important thing to understand here is that if we look at how you value, typically how you like to look at how strong a company's financials are, how you value an unprofitable company is based off of revenue multiples, and how you base profitable companies is price to earnings ratio. And I'll explain that very briefly. $6.7 billion total revenue here, right? The market cap is $40 billion, right? $39 billion. So if you have 6.7 goes into 39, how many times? And that's about 5.5 or so. So there's a 5.5 or so revenue multiple to get to the market cap. So that kind of just tells you people are pretty bullish on this company. because they're having a really high revenue multiple despite the fact they're an unprofitable company. And then you're going to want to look at things like their balance sheet as well, right? And balance sheet tells you how many assets they have. They have $3 billion in assets, and you can see some are current assets and some are non-current assets, and that just means really how liquid they are. Current assets are more liquid, and current and liquid means, the closer to cash as possible, because cash you can spend immediately. Some assets you cannot spend, but they are worth something, right? Think of, for example, intellectual property, right? That's an asset, but you cannot just sell that immediately and get money from it.
Or in this case, cars sitting on a car lot, right? I mean, those are technically assets that have value, but they're not super liquid.
Exactly. So that's something that you would look at here, and look at their assets and how strong they are here. And then you can also look at their cash flow statement. And as we see here, they're only surviving right now because they have a bunch of financing, right? They're losing from operating cash flow. They're losing about $1 billion. They're investing money, and it's mostly financed off debt and off of, continual equity raises from their investors, because that's what tech companies get to do. So we compare that, for example, this company, unprofitable company, $40 billion valuation, to CarMax. I think a lot of people have heard of CarMax as well. They do the no haggle pricing as a car dealership. Their market cap is only $18 billion. And this is what I think is funny. Their revenue per year is $18 billion. So they have 3 times the amount of revenue, right? And so their revenue multiple is literally 1. Right? So it's way less than Carvana. So this is a way less expensive company. So that just means that the investors are, for some reason, pricing this at a lower, capitalized company. And part of the reason is that they don't get that tech bonus. Anyway, their operating income and NOI is essentially, you see here, they have a certain price to earnings ratio, and this is where you value currently profitable companies. The point is to say that the company that we're looking at is kind of in between these two. And the importance of understanding the range of other companies in the space, what their revenue multiples are, what their price to earnings ratios are, what their financial statements look like, what is on their balance sheet. One of the really strong aspects of our current tenant is they have almost no debt on their balance sheet at all, which is incredible. But, that not having no debt also has its own problems, because that means you have to then deploy a bunch of the liquid capital that you have, and you're probably going to end up taking on debt later, right? And you're losing valuation of your company every day that you sit in cash. So you have to deploy it. And what if you make a risky deployment decision? So there's all these investment factors and theses that you want to walk through and go through when you're looking at how strong financially a company is. But this is just a very, very, very brief explanation of how you would begin to do that.
And this is something that we do on all of the tenants that we are underwriting for you, all these investments that we're doing every week. Andy and Joseph are going through and vetting each and every single one of the tenants in this manner, because it's very important. We've said this before, but when you're buying triple net investments, you're really buying the lease, and the lease is only as good as the group that is guaranteeing that lease, that is guaranteeing that income. So it's very important that you understand the quality of the company behind that lease to make sure that you are actually going to be making or receiving those payments.
Exactly, Tyler. So going on to our underwriting today, here is the numbers we got. So we can keep here average investors annual income 150K. If you raise it higher, as we've, and if you guys haven't been watching some of our previous live streams, we have this pre-analysis and post-analysis IRR. What our specific model does is try to help project out what your tax benefits are, including that into your cash flows, because real estate is heavily tax advantaged And we're trying to provide a much more complete financial picture for you guys of the types of tax advantages that you can get. So this is where you see pre-analysis is your IRR, or internal rate of return, before tax, and post-analysis is after tax, right? So that's just something to keep in mind here of what all of this side means. And the more income you make, the more tax savings are worth to you because your income bracket is higher, right? So that's why this number is important. But as for the purchase price goes, our purchase price for this property is currently listed at $6,094,000. And the entry cap rate is 6.4%. So again, if you want to know what that NOI is, you take the purchase price times the cap rate. Your NOI for the first year is $390,000. And how this lease specifically is set up, it is an increase of, I believe, after every 5 years, an increase of 10%, 10% income bump every 5 years. So that is what the cash flows eventually are going to end up being. As far as these due diligence and transaction fee costs are here, right? Due diligence and closing costs, we like to keep in a few percentage points here for all your legal stuff, your taxes, title transfer and stuff, and a transaction fee. This transaction fee specifically would be, if you're coming through a investment company like ours or another to go through this deal. So actually, I want to underwrite this deal first with no asset manager kind of projection. That is a service that we provide to our investors. Is we go through, we help partner with you to manage every aspect of the deal for you from start to finish. But we offer, of course, a wide range of services, whether it's just brokerage and representation, all the way up to that full service package. So that's just something to keep in mind of why we have all of that sort of analysis in here. For the loan to value, we're going to put this loan to value at 75% and a 3.75% interest rate. And in order to see where you're going to be getting terms like this, you're just going to be wanting to talk to your lenders, anyone you have relationships with, and the stronger you are and the stronger the business is, the better terms you're going to get in general. So we have this just at 75%, 375 here, and we're going to put this to 25-year amortization. And our operating capital, what this is just, the couple mortgage payments right here. This asset management fee, again, this is what if we were providing the asset management work on the property, we'll put that to 0 to start. And selling costs, 7%. What does that include? That obviously includes that same transaction cost up here. Also, it includes the fact that as the seller, you're typically going to have to be paying both your broker and the buyer's broker as well, right? So that's what this 7% selling costs results in here. For the hurdle rate, we're actually going to set this to 0% right now because we're giving everything to the LPs. We don't actually want to be showing anything like that. So everything is going to be going to LPs, which is going to be this IRR right here. And actually, I believe I need to make this something very, very small so our model doesn't divide by 0 here. Let's see. I did something here where our model is dividing by 0 and causing this thing to not show up correctly. It's right here. Our annual cap rate growth. We're putting 400 basis points here. No, that wasn't it. Let's see. So here you guys are seeing sometimes when you're going through and underwriting a property, you have something that happens and your model doesn't always work as expected. And that's something that actually happens quite frequently, even when you're very familiar with your models. Things happen. You might miss a number. You might not exactly have input something, you might have put something as a typo. That stuff happens all the time. That's why it's really important to be diligent about checking every single number that you're inputting, making sure that everything is the same, and making sure you didn't miss anything. So this is an exercise for you guys in showing, hey, let me go back and figure out what I did wrong, because it happens. Everybody makes mistakes when it comes to underwriting, and even in models that you're very familiar with, you'll forget something every now and then. So how do you handle this situation? What I'm actually going to do, I'm actually going to start going back through and undoing, and you see how we have problems here on the side. I want to be watching this until I get to the point where I don't have it messed up anymore. Right? Okay. We're still messed up over here. So that means that something is wrong in the current model that I have.
It's probably something that you hard coded when you were going through doing that a second ago. So while Andy's trying to figure that out, for everybody that's still watching, this is a car lot in Tennessee that we are looking at. Typically when we're underwriting these deals, it takes a couple of days. So we will go through and we will pre-underwrite these opportunities before we actually bring them onto you guys. Because it takes time. I mean, you can see Andy's going through all these numbers. There's a lot of stuff that's in these models, and they can be very easy to break, which is why if you're buying these models from us, because we do sell them, there's a link below in the description, we highly recommend that you do not go and hard code or change any of the formulas, because if you change one formula, it could very easily break the whole model like you're seeing right now. So likely what happened is one thing got changed and was hard coded, and that interrupted it.
Yeah, and so in order, guys, and I want to just explain how you would go through and try to figure that out. So for example, if I have a problem here, I see this thing that's showing up value, right? And I said, okay, that's a problem. So I'm going to go, and it tells me this comes from IRR analysis C17, right? So I go over here to IRR analysis, C17, I get value. Okay, this is coming from D17 to AR17. I go here. Okay, so this is pulling from here. And what is the problem here? So I'm going to pull from here. I need to go to scenario analysis E63. That's the that's the type of work that you have to do.
It's a scavenger hunt.
Because this happens all the time. And as you see here, it's obviously something that's happening not in our year zero initial understanding of the model, but it's happening starting here in year one. So I put something in here at some point, and I apologize for you guys that did happen, but this is what happens. I put something in here that is all of a sudden not making it very happy. But this is why, again, as Tyler said, you're going to be wanting to make sure you're very diligent about trying not to hard code stuff. And one of the best practices you do in order to hard code stuff, and let me just go to this pro forma here, because this pro forma is working. So let me say, for example, let's say I wanted to hard code this, because after 5 years, right, after 5 years, the income actually increases by 10%. So you see, here's our typical code here. And this model, as it stands, is not set up to say, after 5 years, increase the NOI 10%, right? It doesn't have any button here to put that. And all models have limitations, because, that's something that you can build in to automatically do that and have all this fancy lines of code. But then all of a sudden you're going to have a bunch of clutter over here, and you can have way more inputs and drop down menus. And then that starts to get confusing. So when you're working on your own models, this is always something that you, for yourself, you want to be thinking about and working on, is what is my balance between functionality and actual output, right? Between functionality but am I actually going to use all these extra buttons and lines? Because if you've seen some people's models, they can get very complicated. And we really, in our models that we're sharing with you guys, we want to make sure that they're very simple and easy to understand. Because you can make underwriting as complicated as it needs to be, as you want it to be, but at the end of the day, there are a certain amount of basic inputs that are very important, right? Of course, your loan rate, how much money you're putting down, all this kind of stuff, right? But you can add all these other layers, and sometimes that might just end up confusing you more than helping you out. Anyway, I wanted to show you guys what you would want to do in a case where you're trying to hard code stuff. So here's our pro forma. And let's say I have all of this, and you guys can see here. I don't know if I can't zoom in on this text box here, but y'all see there's a lot of stuff going on, right? It's checking if this year is greater than 0. If so, it's pulling from a certain number to then multiply by the ratio of rent growth, and then it's an exponent by the year, and otherwise it's going to return 0. So that's, I know this looks like
It's so ridiculous.
it looks like it's total nonsense, but it really, once you understand and you can read this, it's essentially like reading another language. And so I read that to be exactly what I said to you guys, but that's why learning this stuff is important, and it's a very cool skill for you to have. It will make you very valuable. Anyway,
it's so cool.
Let's say
Andy.
I want to. Oh, thank you, Tyler. I know I'm just the greatest, aren't I? So let me say I want to change this here. Usually, what I do, and this is a best practice for you guys, is to hard code the numbers here. To hard code the number, and I'm hard coding these numbers, and I'm gonna change the font. And you can usually either change the font to orange. I like to use orange, or you can highlight to orange. Either way, whichever way stands out more to you that you like better. What I'm actually doing, I'm going to delete all this. I'm going to set this equal to this number, right? And I'm going to set that equal to that number, and I'm going to multiply that by 1.1 to represent a 10% rent bump, right? So it goes from 800 to 880. And then I'm going to actually set this number here equal to this number. I'm going to lock this number. By the way, you see these, if you guys can see on your screen in this code line, you see these dollar signs being added. It's just one trick that you can do. If you press the button F4 on your computer, you can hard lock a cell. That just essentially means that Excel has a thing where you can drag formulas across different lines. It makes your life a lot easier. If you always want to refer to a certain cell, then you press the F4 button, and these dollar signs mean the cell you're referring to is locked. So I'm going to lock that cell. I'm going to drag this over here to year 10, and then all of these are now 880. And let me show you what will happen if I don't lock this cell, right? It's equal to J12. And if I pulled this button over, let's see, it's going to equal to K12, L12, M12. And it just so happens that because it's referring to the square right before it, it's always going to be 880, right? But if for some reason you were doing something else, if you were doing verticals or up and down, you wouldn't want that to happen, right? If I wanted this number here also to be 880, right? If I, for some reason, wanted all of these lines to be 880 this way, and I set it equal to J12, all of a sudden, these are not going to be equal to 880, which I wanted. They're going to be pulling from this square here. So that's one of the important things that you want to learn about when going into this sort of underwriting. But regardless, let's go back to what this actual deal looks like. Looks like our tax flow, our tax analysis, for some reason, is not working right now. But that doesn't mean we can't show you guys what the return on that entire deal looks like, just as we were going over before, right? So I'm going to put this back right at those same inputs that we had previously to show this to you guys. I'm going to take this down to 0. Keep those at 7, keep this at 0, and keep this at 0. So if you brought 25% of the capital to this deal, right? It's a $6 million deal. We have some fees and stuff. That brings it to 6.2, almost 6.3. You have to bring 25% of that down, 1.7 million. Your IRR, or internal rate of return, is going to be 12%, 12.81%, which is a pretty good return. Not even accounting, and yes, we don't have this tax analysis here, but not even accounting for tax, you're getting a 12.81% return over a 10-year hold. And Tyler, you can put that in perspective for the viewers,
I was going to say, absolutely. I mean, let's put that in perspective. That's what value add multifamily groups want to get. Even when they come in, buy something, have to spend a whole bunch of money to upgrade units, reposition the tenant base. So, and that's arguably riskier than this is, right? So a 12.81% IRR is pretty phenomenal.
Absolutely, Tyler. And so you see here, because we did that, we have the 10% bump here. And something I want to show you guys is that this valuation is based off of the forward year 11, right? The year 11 cash flows. And the important thing about that year 11 cash flow is because when you buy a building, right? Just like when you buy a stock, you're buying a share of a company to participate in the future cash flows. The future cash flows, how much money that company will make in the upcoming year. Because the money that was made in the previous year is not going to be distributed to you. It's distributed already. It's the same when you buy a building. When you buy a building, it's about the money that you're going to make in the year that you bought, right? Not necessarily the money that you made in the previous year. So when you buy something at the end of year 10 and it's right about to have a rent bump, this is actually one of the opportune times to buy, because you make sure you have that rent bump in year 1. You wouldn't want to necessarily buy, let's say year 6 and year 7, it just had the new rent, and then year 8. This is probably, in just terms of timing, one of the worst times to buy, because you're on the lower rent for a longer period of time, and you want to be as close to the higher rent as possible, right? You obviously want to be buying something with as much high rent as possible. So that being said, this valuation is based off of this, and you might notice here, what we put in here is 8%. And it's like, Andy, isn't that wrong? Didn't you say that it was a 10% bump every 5 years? Yes, I did. But here's where this is the type of analysis that you have to be able to perform. What if this tenant doesn't renew? There is a risk that this tenant doesn't renew. So how do you price that into your model? You have to price in a certain amount of risk that this tenant doesn't renew. And so what we're doing here is we're taking out some potential gain to price that into our model. And now, in reality, it's not going to be like that. In reality, either they renew or they do not renew. There is no probability. Let's say there's 75% chance to renew their lease, right? Either they renew or they don't renew. There's no like Schrodinger's cat where the cat is alive and dead at the same time, right? That can't happen in reality. So either you don't have the NOI or you do. But for the purposes of a financial model like this, you can't exist in those two simultaneous situations in order to give you one projected return. So you're going to just discount that. You're going to discount that by a matter of risk factor of how risky you think this building is. And I'm sorry, this building is, and subsequently the tenant risk that is associated with the building. What's unique about this property is that this property was actually just recently renovated. The tenant has a 10-year initial lease term, and I believe it is 7 5-year options. It is either 5 or 7 5-year options. I can't remember if it's 35 total years or 35 additional years. But the point of the story is that the tenant has a bunch of options to renew. And this is why we were looking at credit risk, right? Before, at the very beginning of this show. If this tenant goes bankrupt, obviously they're not going to renew. That's a problem. But if they don't go bankrupt and they're making a lot of sales, given the fact that they just spent a bunch of money renovating this particular property, you're obviously going to be doing, they're obviously going to want to continue to stay. So that's something valuable for this, right? Here's another thing to consider. On that final year, right? If they sell out, and this is kind of where we were going and talking about with the Walmart on our last week's deal. When we're looking at that deal, we're saying, hey, there's a potential they renew, they come back, and there's a potential they don't. Well, what happens with the building? It's still a building, right? That's the great thing about real estate, is that even if the tenant leaves, and the tenant is very important to determine the value of the building, you can go find another tenant. You still own a physical piece of land with a building on top of it. So what is that land going to be worth in 10 years? That's a piece of analysis that you can do. This particular plot is on a very high traffic corridor in, an area of Nashville that we think is going to grow very heavily, right? If that's the case, then potentially the land 10 years from now will be worth something too. So that's something that you can look at. It's like, maybe if the tenant leaves, the land and the building itself will be worth a lot more, and then it doesn't matter. Or I can find another car dealership tenant. So these are all considerations to think about on your exit value, because that is really one of the most important things to consider. Is like, can I sell this building for more than I bought it? That will always, make your day happier and will make your investment better. So anyway, I actually think, Tyler, this might be our culprit right here. And here's something.
It's hidden by the. Yeah, there we go.
Here's something, guys, that we were talking about, that thing not working. You see, Excel has this little green arrow here in the top left corner. That means that the formula changed from this square to this square. Something in here is different, because this just means, hey, it gives you a little warning. A value used in this formula is of the wrong data type. So I bet if I sat here and I looked at this number and tried to figure out the difference, I actually would be able to figure out the problem with the model. So I bet it's actually right here. It gives you, that's what is nice about using Excel. It will sometimes be like, hey, you messed up and you should check this. So that's just a pro tip for you guys who are doing your own underwriting at home. You will make mistakes. Mistakes happen all the time, and this is something that you want to check. Look for this little...
Yeah, look for those little green boxes.
Yeah, this little exclamation mark here. Anyway, that's just kind of some of the analysis points that we wanted to bring up for this deal. Obviously, we think this is a very, very good project with the cash flow, with the tax flow analysis. We think that it's going to add, actually, on average, they add 1 to 2 IRR percentage points, and that's annual compounded return for you guys to in basic terms, right? And compare that obviously to the annual return on the stock market. If you're looking at a 12% return, if you buy this deal all in cash, 12.8% return, plus you get 1 to 2% extra bonus points because of tax savings. So you're looking at a 13 or 14% return compounded annually. Oh my gosh, that's incredible. The stock market on average returns 7% a year. So you are close to doubling the stock market by investing in a deal like this, right? So that's the power of real estate, especially if you can find the right deal for a triple net property like this, where you barely have to take care of anything. In this specific property, you only have to take the owner is responsible only for the structure. But the structure doesn't even include the roof. The tenant is responsible for the roof. And so the owner is responsible for the structure. What is that? The slab and the walls? I mean, what's going to happen to the slab and the walls? Unless there's an earthquake or a tornado. But guess what? The tenant pays for insurance. So, the worst case scenario is you're going to have to pay a deductible, and, tornado comes through. You're going to have to pay a deductible on the structure part under your insurance, right? Which the tenant pays for because it's a triple net property. So that's where you see real estate all of a sudden, there can be a huge amount of benefits. It can be very profitable if you pick the right deal, and can be a lot safer. I'm not going to say anything is guaranteed, right? Corona could happen again, God forbid, but something could happen again that's no one had ever predicted. But generally, if you buy right and you have a good broker working for you and a good investment team working for you, you're making sure you're going through, you're very thorough in your analysis, that's real estate can be a great buy, great purchase for you and a great way to, build wealth in your portfolio.
Yep, absolutely. Well, that pretty much concludes the underwriting for tonight. If you guys are interested in investing in this opportunity or purchasing this opportunity, my email is in the description below. Feel free to reach out. I'm happy to hop on a call. Andy and I can both hop on a call and talk to you about it. Or if you're interested in investing in triple net properties in general and just want to hop on a call and work with us to help you go find those assets for your portfolio. That is it for this week. Otherwise, we'll see you guys next week.